Let's get started. Hello, everyone, and welcome to this YCharts webinar. I'm Joe Clevin, Product Marketing Manager here at YCharts, and we are excited to be joined today by Nick Maggiulli, who will be discussing the dynamics of U.S. presidential elections and their influence on investments. As many of you know, Nick is the COO at Ritholtz Wealth Management. In addition, he is the author of the popular blog of Dollars and Data, as well as author of the book Just Keep Buying. Just a couple of housekeeping items for this webinar, and then I will let Nick take it away. First off, this webinar is eligible for CE credit from the CFP board. So all those who are attending this webinar live will get 1 hour of CE credit. We'll be sending out a form for you to fill out with the webinar replay email, which will come shortly after the conclusion of this webinar. So please fill out this form with your CFP board credentials, and we will submit it for you. If you have any questions during the webinar, we're always listening, and you can submit them on the bottom of your screen where there's that Q&A icon. We'll try to get to as many of them as we can at the end of the presentation. Please keep in mind that the content of this webinar is meant for educational purposes only and is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. And finally, I'd also like to point out that a recording of this webinar will be emailed to everyone who attended tomorrow, and it will also be available as a replay on our YouTube channel. All right, so with that, Nick, let's jump into it and start off. So we have 4 topics that we're going to go ahead and cover here. First one is how markets perform post-election, where we'll be taking a look at some of the data that you actually pulled for your blog that just came out on May 21st about presidential elections. We'll compare the Trump versus Biden eras and how certain market and economic indicators have performed, why long-term investing matters. I'm sure a lot of advisors that are listening to this webinar will appreciate this section. Finally, the effects of Congress on markets and some Q&A. All right, Nick, so let's kick it off here. How markets perform post-election. This is one of your charts here from your blog that came out on May 21st about how markets are influenced by elections. It looks like here we've got a lot of different election years looking at the percent change of the S&P 500 performance, if I'm not mistaken, the number of days after election day on the x-axis there. So Nick, walk us through this chart and what were your findings with this?
Yeah, thanks for the intro, Joe. Really appreciate that. And thank you everyone for attending. So yeah, this chart here, we're just going to give a little bit of context for kind of understanding what's happening after election day and what happened, how the markets tend to react. This has every year since going back to 1950. So this is actually YCharts data here, an S&P 500. When I say U.S. stock performance, I mean S&P 500. So just, assume that's true throughout this presentation. And it's just showing how the market tends to perform. Over this period, these 74 years, 18 of them were actual election years. The other 56 were what we'll call non-election years, but I just looked at the same period of time. And there's a couple things that stand out. Obviously, like the percentage change over this period, over this 35 trading day period, can be as much as 10%, as low as negative 10%. So it jumps around a lot. Obviously, an average of a couple percentage points here. But another thing which is interesting is like a lot of these things, a lot of these, what you're seeing in some of these years have nothing to do with the election necessarily. Like that purple line at the bottom where it dropped, 20% in the first, 12 days or so, that was 2008, right? So that has obviously nothing particularly, related to the 2008 election, right, when Obama actually won. I don't think that's why that the market went down. It was probably due to the ongoing financial crisis that was coming on. But this is just an example of like, there's a lot of things that affect markets. And so politics are just one thing within that. And so I want to keep that context here when we actually look at this. And it's actually important for the next slide. Because what this chart is now showing, instead of showing all the years, it's now averaging those 18 years in the election years in red, and then averaging the 56 non-election years in gray. And as you can see, yes, there are some differences, especially right around election day, right after election day. The market tends to go down just slightly, but on net, after you go up through, the next 35 days through year end, you see that there's really no major difference. And I don't think none of this is statistically significant, right, over this period. So just something to keep in mind is like a lot of stuff's going on, but, the elections, they do matter. I'm not saying they don't, but a lot of these things tend to wash out in the long run. So just something to keep in mind within the context of the bigger talk we're giving here. So.
Interesting point, Nick. And looking at the first few days after election day, in the non-election years, you definitely see a bit more of better performance on average versus those election years. And this is days after election day. So maybe there is some negative reaction in those few days following the results when they get posted. But over time, even just 10, 20, 30 days after, you definitely see those lines start to converge and actually move in the same direction with each other, which I think goes well to your point about there's a lot of other effects at play here. So the election is just one of them, correct?
Yeah, exactly.
Well, then, if we drill down just a little bit further and looking at recent history, we pulled this using data here at YCharts and looking at the last two elections, 2016 for Trump, 2020 for Biden. Both presidents, after their election day, had a positive following day on November 9th for Trump and November 4th for Biden. Difference here is that the day after election day for Biden, his performance actually doubled in that, or was double that of Trump rather, in the day after election day. And there was also potentially more positive reaction to his winning the presidency around 2 months after election day. The periods we have here actually were defined as the day after election through inauguration day. Nick, any significance here with any recency bias or the last two presidents that we might be able to take away for what might come in the 2024 election?
I think this data is really interesting because just let's go back to 2016. Like if you remember kind of the how the everyone was feeling at the time before, obviously Trump won and it was kind of a shock to I think a lot of people throughout the nation. Before that happened, I think a lot of people believed if Trump had won, the markets would crash and they ended up not crashing and they actually ended up rallying a bit and not as much as they did during Biden. We'll get to that in a second, but it just goes to show like we have our beliefs about what we think is going to happen. And then even if that thing happens, like the market may not react in the way we expect. Right. And I think one of the best examples of this, there's a great story in with Going Infinite, which is about the Sam Bankman-Fried thing. But he was working at Jane Street at the time, Jane Street Capital, and Jane Street actually got the election results before CNN by like 5 minutes because they were just getting data. They built this whole thing. They had the election. They knew Trump was going to win early, and they made the trade wrong. They bet against U.S. stocks and they ended up losing. They went from making what they were going to make a ton of money because they thought the market was going to crash, and then the market ended up rallying and they lost. It became the biggest loss in the history of the company, which is super interesting to think about that context and how that played out, right? Even though you kind of knew what was going to happen, you still can't predict what the market's going to do. And same thing here with Biden. So yes, Biden post-election, there was probably some relief, like, okay, we're not maybe some relief from certain people thinking that, okay, Trump may be a little bit less certain with how he's going to behave. Maybe Biden's a little bit more like, standard politician. It's not going to be as crazy. So maybe you saw, after the election, you're seeing a better market performance as a result. But what's really interesting, and we'll get into this more later, is that this performance here has no bearing on what happened after this, right? I would say, despite obviously ignoring COVID, which is kind of a one-off thing, overall throughout Trump's presidency, the market has performed better than it did during Biden's, and that may not have anything to do with Trump or Biden, but it just goes to show it's really hard to predict stuff.
Indeed, it is, which I think makes for a great segue into the second topic we have here, which is comparing those two eras of Trump's 4 years versus Biden's 10 years so far. We built these asset class heat maps using YCharts data and our Excel function, showing how asset classes performed in Trump's 4 years and in Biden's through Q1 of 2024. So that's March 31st. A good amount of similarities, Nick. We do see that equities, U.S. growth, S&P 500 have performed well under both presidents. World ex-USA is in the fifth spot there, albeit looks like Trump's cumulative total return is besting Biden's as of now. One stark difference, though, commodities. That was the only negative asset class in Trump's 4 years. So far through Biden's, it's the best performer, up about 77% on a cumulative total basis. So, Nick, advisors might get this from their clients as a question. With there being lots of similarities, but also some stark differences, what is the asset class performance a result of, and how much might be attributed to a president and their policies versus those other effects that you were talking about earlier that are at play?
Yeah, I think a lot of time it really depends the asset class and what's going on in particular. And so we can make arguments in here about why certain asset classes are behaving in a certain way. The one thing I want you to note, I think the big thing here, if you look at Trump, if you just didn't show me one was Trump, one was Biden, and I just saw the asset class ranks, I would say, okay, like Trump's asset class rank looks like how I would expect assets to perform most of the time. Most of the time, I expect commodities not to generate a return. I expect stocks to perform better. And at least, historically it's been US stocks, but I would also expect once in a while, developing markets, emerging markets to do well. So that's all, everything fits. And bonds are performing worse just because on average they don't return as much, right? They don't have that equity risk premium. So that makes sense. It looks like a normal like asset class error, despite the fact that we had COVID and all this other crazy stuff. That looks like a very like if you just average asset class returns over the last 50 years, that's kind of what I would expect the rank to be. Now you look at Biden's and it's very different. And it's very different for a host of reasons, which may be attributable to Biden, but probably aren't necessarily, right? Commodities going up, that's inflation right there. That's a big inflation. And we're going to get into that data later, but that's the story there. That's what's going on there, and that's rare. And so that doesn't happen too often. So when you see commodities surging like that, that means something is not behaving normally within the economy. So that's something that's going on there. And the emerging markets going down, that's I think a lot of that has to do with the conflict between Russia and Ukraine. And so that was also something else. Now, someone might argue, well, if Trump was president, that never would have happened. So emerging markets wouldn't have performed that way. And that's completely possible. We don't know. We can't, play history back with Trump winning again and seeing what, Putin would have done. But we're in the world now. And so this is, you're seeing Biden's is much more dominated by stories and very specific things going on now versus Trump looks like a very normal, I would say standard asset class rank. And once again, you brought this up already, Joe, but S&P 500 number two in both. That's kind of interesting. And obviously, US Treasury is the second to last in both, right? So Treasury is just in general like they return something, but they don't, the returns are never that great compared to, the risks you have to take with equities and other income producing assets.
Well, all good points there. And we'll definitely see what the last 9 months of at least Biden's first 4 years here might bring to us. And we also know, Nick, that there's been talk recently of the Fed potentially looking to cut rates. And so you probably expect those fixed income assets from muni bonds to US Treasuries might get a potential lift because those bond values would rise. Was that something that you might expect? Because I know that in the latter half of Trump's years there, the Fed ended up cutting rates from about 2% back to zero, and that might explain some of the lift there. Is that something you would expect to see?
I mean, yes, that could definitely happen. I think right now the market is still unsure over what, I mean, obviously it goes back and forth all the time. If inflation ends up being too hot, then they're like, okay, they're not going to cut. And,
Mhm.
it's like, month to month, the expectations are changing over rates. And so everyone thought there was going to be a lot more cuts and then they thought those were going to go away. And now they're thinking they're going to cut again. And so every day it changes, as I said. So it's hard to know, but I agree. Yes, if they do cut rates in a drastic way, you should see a positive return for treasuries. It's almost like a mathematical certainty. So.
Well, makes perfect sense. Let's segue then into these next four charts here, which are all from our recent election guide called How Do Presidential Elections Impact the Market? If you haven't had a chance to download it yet, please go to get.ycharts.com, give it a download so you can follow along here and get the charts for your own. First off, we're looking at Trump versus Biden with some employment indicators, some very top of mind ones, Nick. I think you probably agree. We're looking at average hourly earnings versus real average hourly earnings, which is adjusted for inflation. That percent change since more or less Trump's inauguration date through Q1 of 2024. In that middle panel, we have US unemployment rate. Then finally in brown is US labor force participation rate. So these definitely all go together in some way or another. Nick, I'm curious to see what you might take away from this first of the four economic indicator charts we have here for both presidents.
Yeah, so top panel in particular, in terms of hourly earnings, like you're seeing earnings go up, which is good, but inflation, right? So the big story of the right side of the panel is in Biden's era is inflation. And so you actually are seeing like while earnings look like they're going up when you adjust for prices, they've actually gone down a couple percent. And that's why you can see we added this annotation at the turning point between Trump and Biden showing that during Trump's presidency, real average hourly earnings had gone up 6.85%, right, over that period since his inauguration. But since then, using that same scale, they're only up 4.22%, right? Since his inauguration, which means they're down about 2.6% basically, right? Since Trump left office. So that is something to keep in mind is like, hey, as prices have gone up, like, yes, earnings are going up, but they're not keeping up with prices in the same way, right? Otherwise, we would see it would still be at 6.85% on average today. So that's one thing to know. In terms of unemployment, obviously it's good that the unemployment rate has come down. Obviously, labor force participation has not returned to the exact level it was pre-COVID, but there's a lot of other things that go into labor force participation rate, which I'm not going to get into here. But yeah, these are just some of the things to consider. It's like, earnings are going up, but after inflation, maybe not. They're flat to maybe down slightly. So just something to keep in mind in terms of what's going on in the employment picture.
And you mentioned inflation, Nick, which again, great segue into our next of the four charts here, which is consumer behavior. One of these indicators is in fact the U.S. inflation rate, followed by U.S. index of consumer sentiment and U.S. retail gas price, one of the most searched economic indicators on YCharts, in fact. We have here the inflation rate, the difference between Trump's era versus Biden's era, and in that black line, that 1.4% is what the inflation rate was when Trump left office and Biden took office. And that goes all the way down to essentially the demarcation line of each presidency. Would you like to talk about inflation here, Nick, and what you might see from that and how it might have affected consumer sentiment?
It's almost unreal. It's like hard to believe that inflation was 1.4%, like literally less than 4 years ago, because we've been living in a world of, +3, +4% inflation for so long. And it's hard to remember, like, yeah, inflation wasn't really a thing. Like, even when I was, writing my book, like, inflation wasn't really a thing yet. And so I published right into that big purple line. And so it's so interesting to think about the stuff we're thinking about now and talking about day and day. It's a very recent phenomenon, right? And actually, I think if you actually look at the inflation graph, the purple part in Biden's era, and then you look at U.S. consumer sentiment, it's like a mirror image of it. It's literally inversely related. The higher inflation goes, the lower sentiment goes, right? And so you can kind of see that it's pretty straightforward there. I remember Jeremy Grantham was on a podcast and he said something like they created this big model and they said the one thing the market hates more than anything is high persistent inflation. And guess what? Consumers don't like it either because it's uncertainty. People don't like uncertainty. That's just generally true. And that's kind of what you have. Biden's era is loaded with uncertainty and mostly that's due to inflation. And I think in terms of retail gas prices, I think I just saw something recently that they're going to release 1 million barrels from the Northeast Reserve. They're trying to get gas prices down. So prices are still obviously, have gone up since Biden took office and they're trying to reverse that. Are they trying to do that to win over people before the election? I don't know, but there are political things at play with regard to these series here. So.
And continuing the economic data conversation, inflation might play into these housing data indicators a bit, Nick. We see here at the top is U.S. existing home median sales price. In pink, we have U.S. new home median sales price. Then following here, the color coding is U.S. existing home sales. They're in the second panel with purple. U.S. new single-family houses sold in also salmon-colored pink, followed by overall U.S. housing starts in blue there. What do you think might be the implications here for 2024 in terms of the election, Nick, with how much housing data, the value of homes might be going up for those who already own a home, but at the same time, if you're a renter or looking to be a first-time home buyer, as those lines go up, you might not be as happy with the ascending prices and it could put you out of reach. How much of this might be an election issue and are there other factors at play here that you see are important?
Yeah, I think this is a big issue. It's obviously very much related to inflation in a lot of ways, and also related to interest rates, which we're going to get into. But I think the thing people are going to talk about is like it's much more difficult to afford a house today. Obviously, because prices are higher, but also because rates. So you kind of get that double whammy of like even if prices were lower, rates are higher, so you have to pay more interest. So it's like and which means a higher payment for a lot of people, and they don't want to do that. And this is, I think the U.S. existing home sales chart is the most interesting because this is like an Armageddon for the industry in a lot of ways, right? Like you went from, over 6 million homes being sold to now 4 million, like that's 2 million homes sold like on this basis that weren't sold, that people staying put that normally wouldn't have, right? And so think about the number of transactions, real estate transactions, loan processors, all these people that were in this industry are now being displaced and have to do other things, right? And so just thinking about that when you see that data, I think it's going to be something that's going to be discussed a lot. I don't think at least I haven't heard anything from either parties that's going to fix this, except possibly Trump has talked about wanting to lower interest rates, but he's been saying that for a long time. That's probably the only thing that could help. But then again, if interest rates go lower, prices may go up. And so you may, even though you're paying less interest, you're going to pay more for the house. So do you really end up, is it much more affordable? I'm not sure. So I'm not sure either of them have any policies that are directly going to address this, but maybe I haven't read everything on this. So.
And I know that mortgage rates are definitely a big player in that too. That
Mhm.
actually takes us into our last of the four economic indicator charts here, which has a little bit to do with mortgage rates. We're looking at here markets in terms of market value appreciation, valuations themselves with the CAPE ratio, and that all important Fed funds rate, which we know can set a lot of different rates on a benchmark basis. So we see here, Nick, that and as the asset class heat maps also allude to, the market in terms of S&P 500 and other equities has risen across both presidents here during their respective tenures. Valuations, on the other hand, it's been a bit more of a roller coaster. There was some early ascension in the CAPE ratio in Trump's first year. Obviously, a big decline there when spring 2020 hit the world. A lot of people were then buying equities again, which caused it to go up. And then in that correction period of 2022, under Biden's tenure, we saw that CAPE again go into a valley, down from a peak. The Fed funds rate, as we all know, was zero for a while there in 2020 through early 2022, has been hiked aggressively to 5.5%, which again has led to a lot of those high mortgage rates. And on the flip side, some high yield savings accounts and good savings accounts rates people might not have seen for several years actually. So tying all this together, Nick, what might be the implication of things like market valuations and the Fed funds rate, things that might not be top of mind for your average consumer or maybe your average American, but tying that into how the market and what their portfolio balances are at the end of each day, that market level ascending. How might this all tie in as a potential issue for 2024? And are there also, again, other factors at play?
I mean, yeah, I think I'm not sure how much the stock market's going to be discussed in like debates and whatnot. I mean, because under both presidents, obviously the market has gone up in aggregate. Obviously, they both had issues that were unrelated to them in some ways. Like there was the COVID thing during Trump's era, and Biden had 2022, which was obviously high inflation and declining prices. So there was a lot going on there. And it's actually funny when you look at just the CAPE ratio, it's more or less just following prices. Like if you just like, oh, prices went down, well, it's not because earnings shot up a ton, it's because prices are dropping. So the E's staying the same, the P's going down. That's how you get kind of that moving around. The other thing too with CAPE, I know people say, oh, it's elevated, and it may be slightly, but the issue is like the composition of the S&P 500 has changed a lot. This is not what it was in the 50s. It's like we have a lot of tech companies, and those companies are more profitable, and so they have a higher POV ratio, and so they're probably bid up accordingly. And so there's a lot of reasons why CAPE might be as high as it is. Now, I think the thing that is most kind of out of the ordinary on this chart is like seeing interest rates, seeing the Fed funds rate go up, right? Normally, as rates go up, you would think valuations would come down a little bit, right? And they did initially, but now the Fed fund rate is flat, and now valuations starting to go back up. So there's usually at some point this thing breaks. There is there's going to be a point where people are going to say, yeah, why am I paying this much for earnings? And I don't know where that is, and we have no idea. It also depends on the expectations of the market. If people really think that 5.5% is going to come back down, then the prices can front run that in a way. So there's a lot going on here. I think the thing to keep in mind is like, a lot of investors are saying like, hey, why would I go take equity risk when I can just own treasuries that are making me 5% a year? Yeah, inflation's 3%, but I'm getting 2% real. It's close to no risk. I wouldn't say anything's no risk, but it's very close to no risk, at least through the end of this year. They're gonna have to raise the debt ceiling in early 25, but between now and the end of the year, like there's basically no risk. I'll, probably get at least 1 to maybe 2%, like in real return. Why wouldn't I take that over equity risk? And so that's what if you have clients, you have a lot of people you're talking with, those are going to be some of the conversations and ideas they're thinking about, right? They're thinking, why would I take this risk when I can just buy a T-bill? So.
Great points, Nick. No, we do hear that a lot on our end too, with advisors and even wholesalers too, with potential funds being offered and everything under the sun there. Let's go ahead and segue into our third section here about why long-term investing matters. So here we have a very simple chart of the S&P 500 level all the way from 1950 up to Q1 of 2024, near zero, all the way to 5,000 and beyond. So a lot of long-term level appreciation here for the S&P 500 and a lot of wealth being generated along the way. We go to the next slide, and this is taken from our election guide recently released. This is what the S&P 500 looks like if you were to chop it up into the tenures of different presidents. So we have here the last 12 presidents dating back to JFK in 1961, all the way through Biden, again, as of Q1 of 2024. You'll notice there that the value column up in the top left corresponds to what the S&P 500 level was at the end of each president's tenure. An interesting takeaway from this is that only two presidents posted a negative S&P 500 performance in their tenure. That was Nixon, who was down 19.8%, and Bush, negative 36.7%. If we flip this a bit on its head, Nick, this actually was a chart you had for your blog that came out not too long ago. This is just that chart, but looking at percent change for each president there. And again, you can see just two presidents, Nixon and Bush, had a negative return during their respective tenures. What is your takeaway from this, Nick, given the long-term rise in the S&P 500, probably for a lot of equities, individual equities or other indices as well? And how might that change a client's perception of, oh, I only like investing in one party because I don't like the other, or vice versa? And what might you offer as advice to advisors who are looking to have those conversations?
Yeah. So in this particular series, as you pointed out, both cases where the market was, down over a president's tenure, both those presidents were Republicans. And so someone might say, oh, okay, obviously you see Republicans are not good for the market, but then you can find all these counter examples, where the market's up. Like I'll look at all the other counter examples, every other presidency, every other Republican presidency during this time, right? And something else someone could say is like, yes, this is true that, these Republican presidents, these two negative periods were during Republican presidencies, but both of those cases also came directly after Democratic presidencies. You can see in the case of Nixon, it came right after, I think, Johnson. And then in the case of, obviously George W. Bush, it was right after Clinton and the dot-com bubble. And so if you really actually know a little bit about history, like how much of that is George Bush taking over versus the dot-com bubble just imploding on its own accord, right? And so there's a lot of other things going on that I don't think are necessarily like related to the presidents per se. I'm not saying presidents don't matter. That's not true. But I think people like to put a lot more blame on presidents than I think that's really under their control, right? Like the dot-com bubble, I wouldn't blame, President Clinton for that in particular. I don't think he had anything to do with that. That was just the era and what happened. Just like and when it blew up after in Bush's tenure, right? So just things to keep in mind. There's a lot more going on than just the politics here. So keep that in mind.
It certainly seems as there are, which probably gives way to our next chart here for this section, which looks at what if you invested only during the presidencies of one political party. So this chart here, again, goes back to 1950 all the way through Q1 of 2024. And it's showing, in contrast to just staying invested in the S&P 500 since 1950, if you were only to invest in Republican presidencies in the S&P 500 and move to cash otherwise, then in the blue line, it's investing in the S&P during only Democratic presidencies and moving to cash otherwise. Nick, any takeaways here other than what might be the title of your book? I think you wrote that might be called "Just Keep Buying." Any other thoughts you have on this chart and what this might help clients understand a bit more?
Yeah, I think your political beliefs aren't necessarily going to make you rich. So just keep that in mind. So there's a lot of things out there. Obviously, someone could see this and say, look, like obviously it does so much better during Democrats, but it actually doesn't matter when you invest. If you're investing across both, it's far better, right? Superior. So, the thing to keep in mind is like yes, okay, politics matters, politics impacts things, but probably not in the way you think, and it's very hard to predict ahead of time. And so trying to, your political beliefs are not necessarily going to make you rich. So, being more open and seeing like, yeah, markets tend to compound regardless of who's in office. Which is actually a good thing. It shows, hey, the markets are, they do well, they create value, they create shareholder value, and that's good for investors, right? So, that's the thing to keep in mind here, and not worry as much about who's in office at any given point.
Indeed, very true. Before we move on to our final segment here, just a quick reminder that any of the charts that you've seen here are accessible if you're a YCharts client. You can get them on your account and recreate them with your own custom logo there in the bottom left corner and white label them for your own use. So definitely check that out. And if you're not a current client, please sign up for a free trial or get in touch with us because we'd love to help you communicate these insights to your own clients. And with that, Nick, the last section here we'll talk about is the effects of Congress and policies on markets. This graph here shows the impact of one-party control or a divided Congress on annualized S&P 500 performance. So we see here on the left side, it's if a Democratic president is in the White House, what is the congressional makeup? Same thing on the right side, Republican president is in office. What is the congressional makeup there under that president? Interesting to see that the best performers are a Democratic or Republican president, doesn't matter which one, but with a divided Congress. I think the interesting thing to note on this, Nick, is that while government gridlock might not necessarily be ideal for legislative progress, there's also the notion that such a makeup might foster stability and predictability in policy, something that could be greatly valued by both markets and investors. Are you surprised by these results? And what are your overall thoughts on any of that?
Yeah, I completely agree with what you said. Like, I think stability is probably the most important thing. And that's if that stability means a divided Congress, that's fine, right? We don't necessarily want. I don't think anyone would want just one party running the country for a very long time, because I think things would obviously, if you're not representing the voices of everyone in the country, I think you're going to get negative results one way or another. So figuring that out, and just like when I first saw this chart, I'm like, the results are kind of all over the place. Like, there's no real easy story you can tell, right? Like, and so it's like trying to figure that out and trying to say like, hey, like, markets are hard to predict. There's a lot other stuff going on besides, who's in office, whether it's, the House is Republican or the Senate's Democrat or vice versa. Like, there's a lot of stuff going on. And so I think the more important point here is like, divided Congress can work against you, but it can also work for you when they're, even if they're in different parties. If we're working together as a country, that matters too. So like there's a lot more than just who's technically the head of a house or who's in office that can impact a lot of these things, right? Because I don't think we had the division today back in the 50s and 60s in the same way. So that's also another piece of the puzzle here.
Well, there are all the different factors at play. That's definitely true, like we've said for multiple slides here. But pivoting away from maybe a lot of different factors at play, potentially drilling down a bit on what might some of those factors be, and getting into what your thoughts are from your recent blog about those particular policies themselves. So we have three main bullet points here that you did have in your blog on how elections affect the market. And we'll start with Biden's here. We'll likely have a rematch of the last two presidents here as the main candidates. Number one here is taxing capital gains at ordinary income rates. You want to elaborate on this a little bit, Nick? And what are your thoughts on this?
Yeah, so these are kind of some of Biden's proposals, and these are things that will actually impact your pocketbook a lot more than what's going to happen after the election. No one knows. There's a lot of uncertainty there. These things, if they were to pass, or at least if they were to gain popularity in some way, they may actually push the conversation to change policy, which will actually impact your pocketbook in some way. So, taxing capital gains and ordinary income rates, as many of you know now, the long-term capital gains rate is anywhere between 15 to like 23.5%, depending on which. Actually, technically 0 to 3 to 23.5%, depending on which income bracket you're in, among other things. But I think the thing to keep in mind here is like, if this were to change, that would significantly increase the taxes you pay on capital gains. And I don't know I can't remember if there's a limit there for how much you'd have to earn. I think for Biden, he's always said something about $400,000. And I think that's always been the limit. So if you earn less than that, you probably wouldn't have to worry about this. But if your income's over 400K, you might see your capital gains go up, which would impact you in a way. So you'd be spending about 10 to 15% more of your capital gains tax, probably on average, to you'd be paying when you sell assets. So that's the first thing to consider.
And that kind of leads into the second thing to consider, which is taxing unrealized capital gains at the 25% rate. Your thoughts on what the implications of this might be? And I know it's been talked about recently. Any particular insight on this one?
Yeah, so while the first proposal with just taxing capital gains and ordinary income rates, that something like that could pass, or maybe they would adjust it, maybe they lower the rates a little, or so increase the capital gains rates, but maybe not make them income rates. I could see that passing. Something like this is a very controversial policy for a host of reasons. Number one, this is only going to apply to households with over $100 million in wealth, or I think maybe even income. I can't remember which one. I think it's probably wealth. So this would not apply to basically most people in the United States, like less than 1% of people, probably less than 0.5% of people. So it's not going to really apply to most people. But on top of that, I think there's a lot of people that would be against this because even though it doesn't apply to them, just taxing unrealized gains, it's a tricky thing. It's really tough politically. It might even get shut down in the courts for a host of reasons. So I don't think it's going to pass. I think it's out there as like discussing the idea of wealth taxes. I don't think this one makes as much sense in the grand scheme of things. So I'm not too worried about it, but it's trying to be a conversation starter to possibly talk about wealth taxes, which that's a whole nother topic, which we can pass for now. So
Fair enough. And let's move on to the third and final policy you highlighted in your blog, which was the stepped up basis rule and the elimination thereof. Nick, if you wouldn't mind, for our audience who might not have been familiar with the stepped up basis rule, if you wouldn't mind just giving a brief overview of what that would entail and any particular analysis you have on the implications of an elimination of that rule.
yeah, so right now in the United States, let's just assume when someone passes, if their estate is below a certain amount, let's just say $10 million. I think it's like 11 million, and then if you have a spouse, and go up to 22 or something. I don't know the exact numbers, but let's just say less than $10 million to make the math easy here. If your estate is worth less than $10 million and you die, you can pass on all of your assets to your heirs tax free. So all the gains you had will be eliminated. So it's not like if you bought your house for $100,000 and now it's worth $1 million. When you die, if you pass it on to, let's say, one of your children, they're not going to have to pay that $900,000 tax bill. If you sold the house while you were alive, you'd have to pay the capital gains on that $900,000, right? Obviously, there's exclusions and things, but you have to pay for that, right? That's what stepped up basis does. It says, hey, the moment you pass, your basis is stepped up to wherever it was on the date of your death. Now, of course, if the asset keeps increasing in price after you die, they will have to pay those gains. But usually that's between the date of your death and the date they get it and sell it. It's usually maybe a few months, maybe a year if it's kept in courts. It's not going to usually, the value won't fluctuate too much for most assets, right, in a short period of time. So eliminating that would basically mean we have to track the cost basis of all assets. And then when you get those assets, when you sold them, you'd have to pay the tax, right? And so I do think the stepped up basis rule is something that perpetuates wealth inequality in some ways, but I also understand that this is kind of a death tax and people don't necessarily want to do that. So if you have someone who's already created their wealth and they've done that already, why should the government tax you on your income, tax you when you sell it, tax you when it's transferred? Like, I could see why people don't like this, but I think there might be a case for eliminating this rule. So I could see it happening. Of the three, it seems like the most likely of the three to occur, but we'll see.
Indeed, we will see indeed with this Congress we currently have in session, which is divided, by the way. So maybe that'll be good for returns in the next few months. So while it's still in office here, let's figuratively go across the aisle here to how would Trump's policies impact your finances. Again, three main points you highlighted here, Nick, in your blog. Let's start with the first one, which is potential extended tax cuts from the Tax Cuts and Jobs Act, I believe.
Yeah, that was from 2017. So Trump lowered tax rates, especially at the higher end. So those with higher incomes had that those tax cuts will be expiring in 2025 unless Congress does something to pass another law which will extend them or something to that nature. So yeah, obviously if Trump wins, I almost guarantee he'll try and get this passed to keep tax cuts, there. And people generally don't like paying taxes. So this is generally a pretty popular policy, despite the long-term fiscal consequences it could have. So, I completely foresee this possibly passing. I could see it happening again if Trump were to win.
And speaking of taxes, one of those might come in the form of the word tariff, which is other countries potentially not liking to pay taxes on imported products. Second point you had here was higher prices on imported products, known probably generally as tariffs. What are your thoughts here on how the Trump campaign has been putting out the idea of tariffs and the implications that might have on consumer prices and other things like that?
Well, yeah, that's generally. I mean, I don't know all the effects of how it could change prices, but it generally would increase prices on imported products. Trump has talked about a 10% tariff across the board on just on everything coming in, and he's even talked as high as a 60% tariff on Chinese products in particular, right? And I think there's a lot of not I would say not goodwill between Trump and China for a host of reasons, but I could foresee something like that happening, obviously. So yeah, if that happens, we're going to see higher prices on those products. I mean, there's no way around it. I don't think there's a way where that's going to necessarily lower prices. So
The final one we have here is the Federal Reserve influence for lowering rates. I know that this has been talked about before, and I believe Trump has spoken about even potentially abolishing the Federal Reserve or setting rates himself was one talking point. Any particular insight into the Fed's play here, whether it comes to lowering rates, impact on finances, market performance, or just how overall that might be an issue this election?
yeah, I think it is a little troubling that the Trump campaign has talked about, meddling with rates. I mean, you can have your opinion, that's fine, but there is a reason why the Federal Reserve is supposed to be independent, and I think a lot of people like the fact that it's independent because it's not being influenced by things for political purposes, right? If you just imagine if every time a politician wanted to boost their popularity or something, they could lower rates and do all sorts of stuff, which may not necessarily be good in the long term. So I think it's a little troubling to hear stuff like this, but I do also believe that, Trump is going to want lower rates. He's talked about this. So how they do this and the way they do it, I think is more important than the belief for wanting lower rates. I think it's fine to want lower rates. There's nothing wrong with that. I think there's a way to go about doing that so that, you try and keep as much independence as you can with the Federal Reserve. And I think that's what people rely on. As soon as the Federal Reserve doesn't seem independent anymore, there may be lost confidence in the US, the currency, all sorts of bad things could happen, right? So remember, it's not just us we have to think about. We have to think about how others perceive us and how that impacts trade, among other things. So
Makes sense. And a lot of other factors at play, as we talked about before. Well, thank you for your opinions there, Nick, from your blog. Very, very much appreciated. Before we get into the Q&A, two quick reminders here on how you can navigate election season with YCharts. As I talked about just a few slides ago, we do have custom branded client communication capabilities, such as the ability to add your firm's logo to any chart or scatter plot or other visual, as well as your color scheme, custom disclosures, all that great stuff to really take our content that we create and make it your own. So definitely check that out if you're a client. And on the flip side here, we have this whole PDF of our election guide available at get.ycharts.com. If you are a client and have report builder capability, we have a neat template built out in the YCharts templates function of all the visuals that we covered in this election webinar, as well as in the PDF election guide. So by opening this up, you'll have all of the visuals from this guide, as well as this deck, preload into your effectively own slide deck in this report builder tool. Those also will come custom branded with your firm's logo on them, disclosures, color scheme, and all of that awesome stuff there. So definitely take a look at that as well if you have report builder access, and give it a try and add your own charts and other commentary onto it as well, and make this election season your own with YCharts. If you're not a client of YCharts, do consider starting a free trial with us. We'd love to have you. And with that, Nick, let's get into some Q&A. Quick reminder that you can ask some Q&A questions here in the bottom chat bar here with the Q&A icon. I'll go ahead and start a couple here. Claudia asks, I think commodities' drastic change may be affected with supply chain interruptions due to COVID and post-COVID rapid growth to, in quotes, catch up. Do you agree, Nick, is what Claudia asks.
yeah, I can completely see that. I'm not a commodities expert by any means, but obviously the supply chain interruptions caused a lot of things. Uh, caused a lot of issues with commodities. And so as a result, prices have now come up because, people are, they bid them up as a result, because of those supply chain interruptions, right? So I completely could see that as a cause for what's going on here in the market, on top of just, that is, I mean, when you talk about inflation, like general inflation of things, like commodities are like the kind of bedrock of a lot of that. So
Makes total sense. We have another question that came in here about what are the potential implications of Robert F. Kennedy Jr.'s candidacy? So interesting question here, Nick. We looked at the Republican side, Trump and his potential policies. We looked at the Democratic side, Biden and his potential policies. Interesting this election season with the emergence, you might want to call it, of RFK. What might be the implications of RFK's candidacy here, given that it sounds like he's going to appear on a debate stage and he has enough votes, signatures might be to appear on some ballots in some states. Any thoughts there on a third-party candidate effect?
yeah, I think it depends on how things go with his candidacy kind of as he progresses. If he starts like kind of rising in the polls, we could see, it's always possible. I mean, I think third party candidates are tough because they usually don't have enough, push behind them to actually be a real contender. But I mean, maybe it's different this time, right? There's always the someone has to be the first, right? So it's one of these cases where either way he could act as someone who draws the attention to certain issues, right? I think a lot of his economic policies are kind of related to, getting rid of loopholes, getting rid of a lot of these things there that corporations are using, and just making sure that people, what he calls pays a fair tax. So that he would raise taxes on the rich in some ways, whether that's through corporate tax or just through the tax system in general, just income tax. But that's kind of some of the things he's brought up. And yeah, and I don't know all of his policies. I've just looked through them briefly, but depending on kind of how if he pulls votes from one party or another, he in a way he could end up upweighting the other. So if he ends up, hypothetically, let's say he pulls votes from Trump, then in theory, if he doesn't pull enough votes to win, but he pulls enough just away from Trump, he could in theory end up be like pushing people towards, we're pushing people towards Biden's policies, right? If as a spoiler in some way. Now, I have no clue how things are going to play out. I'm not trying to predict anything like that, but that's also another possibility. In addition to him adding stuff to the conversation and kind of creating discussions around certain topics, he could also act as someone who's pulling votes from one or the other, which upweights the other's policies, right? So that's another way to look at it.
Well, we do have about 6 months to go here before Americans head to the ballot boxes. So a lot can definitely change in that time, and we'll definitely see what comes next. Todd here has one more question, which is looking at all this data, would it be fair to say that for a long-term investor, the result of the election simply doesn't matter? Is that too simplified? What might be your response to Todd there, Nick?
I mean, it's not that it doesn't matter. It's just if you looked historically, like how much has that mattered now? The answer is not much. But in the short term, it can impact things, and because of that, that could impact how you behave, right? So if hey, I'm going to hold no matter what. I'm going to hold if Trump wins, Biden wins. I just know there were people in 2016 after Trump won. There were people out there that sold or did something because of an election, and so it impacted their behavior. If you're not one of those people that's going to be impacted by things like that, if you're not going to stick too closely to what's going on with politics, you can kind of ride through those storms. Now, of course, elections matter, especially if like a huge event happens. If we were to like get into a World War III, whoever the president is, that's going to matter. So the election matters in that sense. But a lot of these things are hard to predict ahead of time. That's the difficulty here. And so it's not that it doesn't matter. It definitely matters, but it's hard to predict how it matters. I think that's the difficulty. So.
And Nick, I'll end with this one last question for you, if you don't mind putting on you the spot. We
Yeah.
know that you and everyone at Ritholtz loves using YCharts to create visuals, to educate
Mhm.
your clients, share insights and data, and even identify investments based on your own criteria. Given that the presidential election comes once every 4 years, what kind of client questions are you guys getting at Ritholtz? You, Michael, Ben, Josh, and others, and what are you doing to quell those client concerns for any advisors that are on this call, maybe receiving some of the same questions from their own clients?
I think the questions we're receiving, and remember, we're very long-term focused. So we're trying to say like, how is this really going to impact the plan, right? We go back to planning as the core thing. And so it's like, we have this 20, 30, whatever your plan with our clients. And it's like, how is this election going to impact that plan? We obviously don't know how it's going to impact, but at the same time, it's like in the grand scheme of things, it's kind of goes back to what Todd asked, like how much does that really matter, right? I think the things we do care about, it's like rates, rate decisions, housing decisions, like how is this going to impact your individual life? How are the policies going to impact? That's what I think is more important, is thinking about those things, thinking about inflation, thinking about inflation, assumptions going forward, rates, what are those going to be? Those are going to have a bigger impact on your clients and our clients than, who necessarily wins the election. So thinking about all those in context, I think is to kind of, keep your eye on the big picture, and at the same time, like what are the things that matter? And I think for most people, most consumers, it's going to be inflation, it's going to be rates, right? And so following that data and talking to your clients about that is probably more important than who's necessarily going to win the election. So
Fantastic advice. Well, appreciate everyone joining today. And Nick, any last thoughts you'd like to share? Any advisors in this call who might be wondering about those election implications, or just parting words from yourself?
Oh, no, I just want to say thanks everyone for coming out. I really appreciate your time. Hope you guys enjoyed this. And yeah, feel free, if you have any other questions, feel free to reach out to me on Twitter, LinkedIn, whatever. I try to answer every DM. So yeah, send me a question if you have anything. Thank you. Thank you so much.
Fantastic. Well, thank you everyone once again for joining. Do mention Nick Maggiulli for 20% off YCharts for new clients. Start a free trial at YCharts.com to unlock all these fantastic capabilities that we shared. Nick, it was an absolute delight having you on here. I'm humbled to have been able to do this with you and have such an insightful discussion. One last reminder for all you attendees is that this recording will be emailed to everyone. A replay will also be available on our YouTube channel. So make sure to like and subscribe there so you don't miss out on any great webinars like these. Nick, once again, thank you so much, and we will see you all hopefully for the next YCharts webinar. Take care, everyone.
Thanks, Joe. Appreciate it. And thanks, everyone.